Imagine this. It's a Tuesday afternoon. You've just written the final check to pay off your mortgage, $42,000. Your savings account drops to $3,200. Your emergency fund? Gone. But in this moment, you feel invincible. You own your home free and clear. No bank can touch you. You post on Facebook, "We're debt-free," with celebration emojis. Your friends congratulate you. Dave Ramsey would be proud. But 6 months later, the company you've worked at for 12 years announces layoff. Your name is on the list. You're sitting in a $480,000 house with $3,200 in the bank. You can't pay the electric bill with a granite countertop. You can't buy groceries with a brick from your foundation. You call your bank for a home equity loan. They say, "Sorry, we need to see 24 months of stable employment history." Congratulations! You're house rich, but cash poor. Welcome to what financial advisors call the liquidity trap. Today, I'm going to show you why the wealthiest Americans approach mortgage debt completely differently than what you've been taught, and why the math might surprise you. Here's what they don't teach you in school. Equity doesn't pay your bills. Let me be crystal clear. I'm not against owning your home. I'm against trapping all your cash inside your walls while leaving yourself financially fragile. Think of it this way. $500,000 in home equity means you can't access it without selling, which costs 6% in realtor fees. That's $30,000 gone. Or you need to borrow against it, which requires good credit and income. But $500,000 in a brokerage account? You can withdraw it in 3 business days anytime for any reason. Which position gives you more options during a crisis? The 2008 financial crisis taught us a brutal lesson. Thousands of Americans owned their homes 100% and still lost them to property tax liens, special assessments, and unforeseen costs they couldn't pay. Ownership without liquidity is an illusion of safety. Now, let me show you the math that changed how I think about debt. You have a $300,000 mortgage at 3.5% interest. This was common if you bought or refinanced in 2020 or 2021. You have an extra $1,500 per month. You could either pay extra toward principal and become debt-free in about 13 years, or invest it in a low-cost S&P 500 index fund. Let's run both scenarios over 30 years. Option A is aggressive payoff. Let's call this person Sarah. She pays off the mortgage in 13 years. Total interest paid is about $89,000 versus $184,000 if she took the full 30 years. She feels amazing because she's debt-free by age 48. At age 65, she owns a house worth about $650,000, assuming 3% appreciation. Her total net worth is $650,000. Option B is invest the difference. Let's call this person Michael. He keeps the 30-year mortgage and invests $1,500 per month. The historical S&P 500 return is about 10% annually. That's 9.8% from 1928 to 2024, including dividends. At age 65, his house is worth $650,000, but his investment account is worth about $2.9 million. His total net worth is $3.55 million. Michael is $2.9 million richer. But here's what's even crazier. In the USA, mortgage debt gets special treatment. For federal tax benefits in 2026, the mortgage interest deduction applies to up to $750,000 of acquisition debt for homes purchased after December 15, 2017. But only if you itemize, and you need total deductions greater than $29,200 if married, or $14,600 if single. Private mortgage insurance, or PMI, is now deductible again, starting 2026. It was expired from 2022 to 2025, but it phases out for incomes above $100,000. Here's the reality check. Only about 12% of Americans itemize in 2026 due to the high standard deduction. This benefit mainly helps high earners in the 24% or higher tax brackets. people with expensive homes over $600,000, and those in high-tax states like California, New York, or New Jersey, where state and local taxes plus mortgage interest pushes you over the standard deduction. Here's an example. A $400,000 mortgage at 4% equals $16,000 per year in interest. If you're in the 32% federal tax bracket and you itemize, this saves you about $5,120 per year in taxes. Your effective interest rate drops to about 2.7%. Now compare that to your alternatives in 2026. If you pay off a 3.5% mortgage, you get a 3.5% guaranteed return with zero risk, but the money is locked in your house. A high-yield savings account from Marcus, Ally, or Discover pays 4.5 to 5% with zero risk because it's FDIC insured and you get same-day liquidity. A 10-year Treasury bond pays 4.2 to 4.5% with minimal risk, and you can sell anytime. An S&P 500 index fund has historically returned about 10% long-term, but with high risk because it can drop 30 to 50% and you get 3-day withdrawal time. If your after-tax mortgage rate is 2.7% and a risk-free savings account pays 5%, why would you rush to pay off a 2.7% loan? Here's something almost no one talks about. The 30-year fixed-rate mortgage is an American superpower. Most countries only offer variable rates or 5-year fixed terms. Here's why this matters. Let's say your mortgage payment is $2,000 per month in 2026. In 2026, $2,000 feels substantial. But in 2036, with 3% inflation, that same $2,000 payment feels like $1,488 in today's dollars. In 2046, it feels like $1,106. In 2056, it feels like $822. Your payment stays frozen. Your income hopefully rises with inflation. The debt becomes easier every single year. Meanwhile, if you paid it off early, you gave up decades of investing that cash at higher returns, the psychological benefit of watching debt shrink in real terms, and liquidity for emergencies. Okay, let's pump the brakes. I'm not saying everyone should keep their mortgage forever. That's financially reckless advice. Here's when paying off does make sense. You should prioritize payoff if your interest rate is 6% or higher. In 2023 and 2024, many people got stuck with 7 to 8% rates. Paying off a 7% loan equals a guaranteed 7% return, which is better than most stocks after taxes and risk. You should pay off early if you have less than 6 months emergency savings. Fix this first before investing or prepaying. Build 6 to 12 months of expenses in a high-yield savings account. You should pay off if you're nearing retirement within 10 years. Bonds and conservative portfolios return about 4 to 6%, which might not beat your mortgage rate after taxes. Peace of mind beats marginal returns at that stage. You should pay off if you have high-interest debt elsewhere, like credit cards at 18 to 25% or personal loans at 10 to 15%. Always pay these first using the debt avalanche method. You should pay off if you lose sleep over debt. Psychological cost is real. If anxiety outweighs financial optimization, then pay it off. Mental health is more important than spreadsheet optimization. You should pay off if you have unstable income, like self-employed, commission-based, or gig work. Variable income means higher risk of missed payments, so a safety buffer matters more than investment returns. On the other hand, you should keep the mortgage and invest if your rate is below 5%, especially below 4%. You should invest if you already have 12+ months emergency fund saved. You should invest if you're maxing out retirement accounts like your 401k, IRA, and HSA. You should invest if you have high risk tolerance and won't panic sell in crashes. You should invest if you have a long time horizon of 15+ years until you need the money. You should invest if you have stable W-2 income. You might have heard that you should keep a mortgage so you look broke on paper and creditors can't take your house. This is mostly wrong. Let me explain what's actually true. Homestead exemption laws vary by state. Some states have unlimited protection, like Florida, Texas, Iowa, Kansas, Oklahoma, and South Dakota, but with acreage limits. You can own a $5 million mansion free and clear, and creditors can't touch it in these states. Other states have capped protection based on 2026 amounts. California has about $600,000, but this varies by county. Nevada has $605,000. New York has $192,000. Federal bankruptcy protection is about $27,900 or your state amount, whichever is higher. What this actually means is if you're in Texas with $800,000 in equity, you're fully protected. But if you're in New York with $800,000 in equity, only $192,000 is protected, so creditors can force a sale and take $608,000. The truth is, having a mortgage doesn't hide your house from lawsuits. Creditors can still force a sale and take equity beyond the exemption. Better asset protection strategies include umbrella insurance, which provides $1 to $5 million in coverage and costs only about $200 to $500 per year. This protects against lawsuits before they reach your assets and is 100 times better than keeping a mortgage for protection. You can also use LLCs or trusts if you're a business owner or landlord to separate personal and business assets, but this requires proper setup with an attorney. Retirement accounts like 401k and IRA are federally protected from most creditors, so max these out first. Bottom line, don't keep a mortgage for lawsuit protection. That's a myth. Get proper insurance instead. Here's the simplest decision tree for most Americans in 2026. Step 1. What's your mortgage rate? Step 2. What's a high-yield savings account paying? Check Ally, Marcus, or Discover because they're currently at 4.5 to 5%. Step 3. Simple math. Scenario A. You have a 3% mortgage. A high-yield savings account pays 5%, which is risk-free, and FDIC insured up to $250,000. Your action is to keep the mortgage and park extra cash in the high-yield savings account. The outcome is you earn 5% and pay 3%, so you net a 2% profit with zero risk and full liquidity. Scenario B. You have a 7% mortgage. A high-yield savings account pays 5%. Your action is to pay off the mortgage aggressively. The outcome is a guaranteed 7% return, which beats the 5% savings rate. This is dead simple. No stock market risk, no 30-year projections, just math. If you're finding this valuable, hit that subscribe button right now because we dive deep into finance strategies most people never hear about. We post new videos every week that could literally change your financial future. Don't miss out. Want the best of both worlds? Here's an advanced move. The goal is to be mathematically debt-free while keeping full liquidity. The strategy works like this. Keep your mortgage. Let's say it's a $2,000 per month payment. Build an investment portfolio that generates $2,000 per month in passive income from dividend stocks with 3 to 4% yield, bond ladders, REITs, or just a pile of cash earning 5% in a high-yield savings account. Set up automatic payments from your investment account to your mortgage. What you've achieved is your assets pay your liability. You're functionally debt-free because your income covers the payment, but you maintain full access to the principal for emergencies. You can still invest the difference for growth. Here's an example. $480,000 in investments earning 5% equals $24,000 per year, which is $2,000 per month. Your mortgage payment is $2,000 per month. You're covered. And if you lose your job, you have $480,000 liquid versus $0 if you'd paid off the house. Okay, enough theory. Here's your step-by-step checklist. Phase 1 is get the data this week. Pull your mortgage statement and find your exact interest rate. Check if you itemize taxes by looking at your 2025 tax return for Schedule A. Calculate your after-tax mortgage rate using the Smart Asset Calculator. Check current high-yield savings account rates on bankrate.com or NerdWallet. Review your state's homestead exemption by Googling your state name plus Homestead Exemption 2026. Phase 2 is emergency fund first over the next 1 to 6 months. Before anything else, build 6 to 12 months of expenses in a high-yield savings account. This is non-negotiable because it's your safety net. Use Ally, Marcus by Goldman Sachs, or Discover, because they all pay about 4.5 to 5%. Phase 3 is debt hierarchy, and this is ongoing. Pay off debt in this order. First, credit cards at 18 to 25% interest. Kill these immediately. Second, personal loans or car loans above 8%. Third, student loans above 6%. Then, decide between mortgage payoff versus investing. Phase 4 is the decision matrix. If your mortgage rate is less than your high-yield savings account rate, keep the mortgage and pile cash into the high-yield savings account because you get liquidity plus higher return. If your mortgage rate is less than 5% and you have high risk tolerance, keep the mortgage and invest extra in index funds like Vanguard VTSAX or Fidelity FSROX and set up automatic monthly investments of $500 or $1,000 or whatever you can afford. If your mortgage rate is greater than 6%, pay down aggressively because the guaranteed return beats most investments. Phase 5 is automate and forget. Starting in month 7 and beyond, set up automatic transfers to your investment or savings account. Rebalance once per year, not every week, to avoid panic selling. Revisit this decision every 3 to 5 years or when interest rates change significantly. Phase 6 is professional consultation. Hire a CPA or tax advisor for a $300 to $800 one-time consultation to confirm if you benefit from the mortgage interest deduction and review your overall tax strategy. Hire a fee-only financial advisor, and you can find one at napfa.org. Look for someone with a CFP certification, which stands for Certified Financial Planner. Avoid commission-based advisors because of conflict of interest. This should cost $150 to $300 per hour, or 0.5 to 1% of assets under management. Hire an estate planning attorney if your assets are greater than $500,000 to set up trusts or LLCs if needed and develop asset protection strategies. Here's the part nobody likes to admit. The math says invest, but humans aren't spreadsheets. In 2008 to 2009, the S&P 500 dropped 57% from peak to trough. If you had $100,000 invested, it became $43,000. The question is, would you have held or sold in panic? Statistics show the average investor sold at the bottom and locked in losses. They underperformed the market by about 4 to 5% annually due to behavioral mistakes. In March 2020, the market dropped 34% in 23 days. If you had $200,000 invested, it became $132,000. Did you buy more or did you panic? Here's the truth. If you'd panic sell during a crash, pay off the mortgage because the guaranteed return is better than losing money in stocks. If you'd stay calm and keep buying, then invest because you'll likely come out ahead. Know yourself. Honest self-assessment beats perfect math. Let me challenge my own argument for a second. When is home equity actually valuable? Home equity helps us force savings for undisciplined people. If you'd blow extra cash on nonsense, locked equity is better than nothing. A mortgage payment is automated wealth building. Home equity provides stable housing costs in retirement. No payment makes it easier to live on Social Security plus pension. Predictable expenses matter when income drops. Home equity gives you the reverse mortgage option at age 62 and above. You can tap equity without selling. It's not always a good deal, but it's an option. Home equity enables a downsizing strategy. Sell a $600,000 house, buy a $300,000 condo, and pocket $300,000 tax-free, up to $500,000 if married. Equity becomes liquid in retirement. So equity isn't dead. It's just illiquid. There's a difference. Here's what I believe after looking at all the data. The old rule was, pay off your house as fast as possible, because debt is evil. The new rule is optimized for liquidity, after-tax returns, and personal risk tolerance. For most Americans in 2026, if your mortgage rate is less than 5%, Keep it and invest the difference. If your mortgage rate is greater than 6%, pay it down aggressively. If your rate is 5 to 6%, it's personal preference between peace of mind versus potential returns. Always prioritize in this order. First, emergency fund of 6 to 12 months. Second, employer 401k match. Third, high-interest debt payoff. Then, optimize between mortgage versus investing. Look, I get it. Everything in you wants to be debt-free. It feels safe. It feels responsible. But ask yourself, what's safer? $500,000 locked in your walls with $5,000 in the bank? Or $200,000 in home equity, plus $300,000 liquid in investments, plus $50,000 emergency fund? I'd take option 2 every single time because real wealth isn't about what you own. It's about what you can access when you need it. Here's your homework. Pull your mortgage statement today. Check high-yield savings account rates. It takes 60 seconds on bank rate. Run the numbers and be honest about your risk tolerance. Book a consultation with a fee-only CFP, not a salesperson. Make a decision based on your situation, not internet gurus. Before you go, I want to hear from you. What's your mortgage interest rate right now? Are you planning to pay it off early or invest the difference? Drop your answer in the comments below because I read every single one and your situation might help someone else make a better decision. This video is for educational purposes only and is not personalized financial, tax, or investment advice. Mortgage and investment decisions depend on your individual situation, risk tolerance, current interest rates, tax bracket, and state laws. Past investment performance does not guarantee future results. Markets can lose value, and not paying off debt early carries risks, including foreclosure if payments are missed. Always consult a licensed financial advisor, tax professional, and attorney before making any changes. This applies primarily to U.S. fixed-rate mortgages, as rules differ internationally. If this video changed how you think about debt, do me a favor, hit the like button right now. Subscribe if you haven't already, because we post deep finance content like this every week. And share this with one friend who's obsessed with being debt-free. They need to see this. Thanks for watching, and I'll see you in the next one.